morning, good evening, good afternoon, everybody. Welcome to day number 7 for the 30-day Investing Basics Challenge. Today, we're going to break down business and investing cycles. So today, once you get done, you should be able to understand a basic investment, a basic economic and business cycle, and use that to help you plot along in your overall investment journey. Now, when you're thinking about the economy and how the economy grows, or even a business for that matter, it usually ebbs and flows. So we just want to take a quick minute and go on over to the slide and take a look at that for a quick second. So right here we have a nice little graph of the overall economic cycle. And if you look to the left, you see the very first thing is recovery phase. Some may even call that depression. It's basically at the bottom level or the lowest level of the economic cycle, or even the business cycle. Now remember what I said, economic cycle, business cycle, they both go through different cycles. It's very much like life. You have ups and downs, sideways and forwards. But during the recovery stage, or the recovery phase, or also called as the depression, it's usually the lowest point, and you start to see stimulatory economic policies. Well, we all know about that, right? Cute little letters called QE. We're still dealing with those now in the U.S. Confidence starts to pick up. Inflation is falling. Now in the overall markets, you see short rates low. We definitely can relate to that. Interest rates right now in the short term are anywhere between 0 and 0.25%. Bond yields bottoming. Now we definitely saw bond yields bottom roughly about a year ago. They hit a low of about 1.5, a little bit less than that on the 10-year treasury. Stock market rising. We're seeing that commodity prices rising. Property prices falling. Well, we definitely saw that a few years ago. Now, as you kind of go along and you come from here and you go up, you see early upswing phase. Some may call that growth. Some others may call it expansion as well. And you see confidence begins to increase. Economics, healthy economy starts to come back in play. Typically, inflation remains low. And the markets, the short rates are usually neutral or tend to be flat. Bonds are stable, and the stock market is strong. Commodities are strong, and property prices are starting to pick up. Now, as you start to get to the top of the boom, they call it sometimes a late swing phase. Boom market mentality. Basically, now everybody wants to invest. Inflation starts to pick up, and policies become more restrictive. So then you start to see interest rates tend to rise. So we're starting to see that now a little bit when we saw Janet Yellen talk about raising interest rates. Bond yields are starting to rise. We're seeing that now in the 10-year treasury, and the stock market starting to top out. Many believe that the stock market has already topped out. So we're seeing these middle things. On the flip side, as we start to go, the market or the economy starts to slow down, you'll see the economy and the confidence will begin to slow down. Short-term interest rates will begin to peak. The stock market will begin to fall. Property prices will probably not go any higher. And then you come into what's called a recession, where confidence is really weak and inflation starts to kind of peak out a little bit. And then in the markets, you start to see short-term rates fall out. Now, this is really important when you're thinking about your investments, because you want to know where in the investment cycle are we. Now, no one can predict where the markets are going. We can only be reactionary, but we could look and see, does these typical swings or phases in the market have any correlation or differences, or I guess connectivity to what's going on when you're starting to look at investing. So now we can clearly see in the early stage upswing phase, inflation is low. Well, inflation is low in the U.S. right now. The economy is kind of healthy, but we're not sure. But the short rates aren't neutral right now. They are neutral right now, but they're talking about them starting to rise. Now, but you see, in the next phase, it says late upswing phase. short rates begin to rise. So we're probably somewhere in between these two. Now, I don't have a glass ball or any tea leaves, but I would bet dollars to donuts that this is about where we are. Property prices are rising strongly. We're seeing that, but we've also seen property prices rise. So, but we've also seen in other places in the United States that they haven't basically done the best that they could possibly do. So this is a quick overview of the economic cycle. Remember, you can think about this and know where you are in the economic cycle, and you say, wow, is now a good time to invest, or is it not a good time to invest? So that's it for the economic cycle. Well, now that you've had a chance to look at the slide and you've seen everything, now you understand how the market cycle goes up, down, sometimes sideways, but you can use it to your benefit. Remember, knowledge isn't power, but applied knowledge is power. I'll see you for the next time for the number 8 video in the series. And the next time we get together, we will be talking about the overall anatomy of the market. So we're going to be talking about the overall anatomy of the market. So I'll see you next time. Don't forget to subscribe to the YouTube channel, and I'll see you tomorrow. Bye-bye.